steps. Step number 1, how money is created and destroyed. Let's review this quickly. We're going to use a chart from the Bank of England's report in 2014. Diagram just as a reference point. But we've got 3 balance sheets. The central bank on the left, a normal commercial bank in the middle, and the average Joe on the right. It starts off with example A. The Fed, or the central bank, on the asset side of their balance sheet has treasuries and mortgage-backed sausages or securities, and they have bank reserves, the funny money they create out of thin air. The banks, the commercial banks, assets, bank reserves that are the liability of the Fed, and customer deposits. The average Joe, those deposits are his assets and his liabilities, typically going to be debt or maybe equity if he doesn't have much debt. So in step B, let's see how money is created. The average Joe goes to the bank. He says, listen, I need to get a loan for a car or a house. The bank says, okay, no problem. So they create a loan for the average Joe. This loan becomes an asset on the bank's balance sheet, and they create an additional deposit in Joe's account. So in this process, money has been created. If we started with $100 of money supply, all of a sudden, now that Joe took out this loan, or the bank gave him extended credit to him, we have $150 in the total money supply. This is considered money printing by people like Dr. Lacey Hunt, someone who's always on Macro Voices, been on Real Vision, one of my favorites. And it's considered M2 money supply, or broad money, if you're looking at charts from the Federal Reserve. But in example C, it can go the opposite direction. Let's say Joe took out that loan and he immediately paid it back. The money supply would decrease by 33% and go right back to $100. So this is a quick example of how money can be created and destroyed. But let's think through a couple things before we move on to step number 2. First, let's look at what could happen to the cost of bread. When we had $150 in the system, let's say we had 10 bakers. Well, now because of the cerveza sickness, people are paying down their debt. Let's say the money supply contracts down to $100. That's the deflationist argument. But because of the supply contraction due to the cerveza sickness, let's say the number of bakers goes from 10 all the way down to 1. So we reduce the supply of bread by 90%, while the money supply is contracting by 33%. What's most likely going to happen to the price of bread in this situation? It's going to go up. And the objective of this video is not to argue for inflation or deflation. It's just to give you some food for thought. So going over to the left, the first takeaway is that credit going up or down versus the amount of principal payments that are being made is going to give you your broad money supply. And what happens if there's a default, so people don't pay back the loan at all? Usually we don't think through this process, but it's very important. 2 things can happen. Either it can do nothing because the money is still out in circulation, meaning the money supply doesn't change, or over time it could decrease the money supply if it negatively impacts the bank's balance sheets enough to prevent them from lending more or creating more money in the future. And of course, the third takeaway is the wild card. The government, your drunk, insolvent Uncle Sam. They have the ability to create deposits or to create money supply by spending it into existence, having the Fed monetize the debt, whatever you want to call it. So if they continue to deficit spend $3, $4, $5, $10 trillion a year, that could create additional money supply above and beyond what's being destroyed by principal payments or banks not lending as much as they were in the past. The biggest takeaway from step number 1 is you realize commercial banks have the most control over the money supply. They can expand the money supply by lending it into existence at a faster rate than people are paying down the principal. So the money supply on net balance will expand. Or if they don't lend at a fast enough rate to keep pace with the amount of principal that's being paid off, on net balance, the money supply will decrease. Step number 2. We discussed why the money supply goes up and down, but now we really need to understand velocity. It's just as important as the money supply going up or down when we're trying to figure out if negative interest rates can create a dollar hyperbubble. And we're going to put all these pieces of the puzzle together in step number 3. But going back to velocity, as an example, let's try to think through a scenario where we'd have $15 worth of debt that we could pay off with only $11 in the system. It starts off with Landlord Larry, and he is definitely ballin', has his pimp cane there and his gold chain. He has a $1 bill in his pocket. Well, Borrower Bill wants a job. He wants to be Landlord Larry's chauffeur. So he needs to go to the bank and borrow $10 because Landlord Larry is going to sell him his Cybertruck for $10 so Bill can drive Larry around and make some money. So Bill goes to the bank, says, "Listen, I need a loan for $10. The bank says, "Fine, here you go." The bank gives him the $10. Borrower Bill gives the $10 to Landlord Larry. Landlord Larry sells him his Cybertruck. So now we have $15 worth of debt in the system. $10 of principal, let's call it $5 in interest. But our total money supply, or the amount of currency units we have in the system, $11. So let's assume Landlord Larry is paying Borrower Bill $3 a month to drive him around. With those $3, Bill pays the bank back $2 in principal, $1 of interest. But the bank is leasing space from Landlord Larry. And of course, they pay him $1 a month in rent. So let's look to see what happens to Landlord Larry's profit and loss. Well, month 1, he starts off with $1 bill in his pocket. He gets $10 from Borrower Bill, so he's got $11 total, but he's got to pay Borrower Bill $3. So he's got $8. He gets $1 in rent, so he has $9 total. Month 2, he's got to pay Borrower Bill $3 again, but he gets the $1 in rent. You can see how this plays out. Month 2, Landlord Larry has $7 at the end of the month. Month 3, $5. Month 4, $3. And month 5, $1 again in his back pocket at the end of the month. So what's happened during this time frame, these 5 months, is Borrower Bill has made $15. The bank has been completely paid off with only $11 in the system. So we can see how important it is for money to circulate within the system. There has to be this velocity in order for the debt to be paid off. And if it's not, if there's a default, yes, short term, it might not reduce the money supply, but long term, it most likely will. It'll impair the balance sheet of the bank, and they won't be able to create as much money moving forward into the future. So the main points I want to emphasize from step number 1 and step number 2, aside from the wild card of government spending, is if banks are creating fewer loans, they're creating less money supply, while at the same time consumers are paying down debt or paying down debt at a faster rate, and you have the velocity of money slowing down, you're going to have fewer and fewer dollars in the system. Step number 3, negative interest rates over the long term will most likely lead to less lending and lower velocity. So here's how negative interest rates could create the dollar hyperbubble. It starts going back prior to 2008 and understanding how the Fed manipulated the Fed funds interest rate. And I know Jeff Snyder would disagree with this. He doesn't think this is actually how it worked in practice, but here's how they taught it in textbooks. If the Fed wanted to take interest rates, the Fed funds, from 5% down to 4%, they would buy treasuries or T-bills from the banking system, the primary dealers. This would create more liquidity in the system or more cash. Because what happens, the Fed buys the T-bill from, let's say, Bank A, and they print up funny money and put it in Bank A's reserve account with the Fed. This creates more reserves, bank reserves, in the system. Therefore, if Bank B needs to borrow money from Bank A overnight, there's more money in the system. Therefore, interest rates for the overnight lending most likely go down. Just simple supply and demand. But then what happened in 2008, 2009, the Fed started quantitative easing. Well, this injected so much funny money, so many bank reserves into the system that interest rates dropped straight down to zero, and there's no way the Fed could have increased interest rates because there was just too much cash in the system. The overnight rate always would have been at zero or possibly at negative, but most likely it would have just been stuck right at zero. So the Fed introduced something called IOR and IOER. This is interest on reserves or interest on excess reserves. So if the Fed, let's say, wanted the interest rates, the Fed funds, at 1%, they would pay banks 1% on their reserves. Now what would happen if Bank B needed to borrow money from Bank A would charge Bank B a higher rate of interest than 1%, because why would they lend any money at all when they could just get 1% with their money parked at the Fed, or not really their money, their bank reserves parked at the Fed. So what happens with Bank B, let's say they need to make a loan, and I want to be clear, they're not lending their bank reserves. They're just using those bank reserves to backstop the loans they're creating. And that goes back to step number 1 and several videos I've done on how money is created. But remember, they're not lending their bank reserves. They're just using their bank reserves to back up the additional loans they're creating. I want to be redundant on that because it's very difficult for people to understand that concept. So in this example, Bank B would make a loan to the customer at 3%. So the customer is paying Bank B the 3%. But Bank B, let's say, would pay 2% for the reserves that back up the loan. So they're pocketing the 1%. But what would happen if the Fed takes IOR negative? Let's say to negative 5% in example C. Well, if Bank B needed to borrow money again, Bank A would lend them the money and they'd actually pay them to take the money. Why on earth would they do that? Because the Fed is charging them 5%. So if they can pay someone 4% to take their money, they're actually making 1% on the transaction. And this is where most people get really confused. They think, okay, well, if Bank B is being paid 4% to borrow the money, even if they lend it out and have to pay the borrower 1%, Bank B is still making money because they're pocketing the spread between the negative 4% they're being paid and the 1% they're actually having to pay the customer to borrow the money. But let's think through what happens to the money Bank A pays Bank B 4% to borrow. Those are reserves. So Bank B takes the money and puts it in their reserve account, in which the Fed charges them 5%. So you have this scenario where although Bank B is being paid 4% for the money, they're being charged 5% to hold it at the Fed. So they have to pay 1% when everything nets out for the reserves, and they have to pay the borrower 1% for taking the money that they create through the loan. Any way you slice it, that is a horrible business model. What it boils down to is even if the banks were able to charge the customers for their deposits, because the system has been so distorted, there'd be a lot less lending moving forward. And a lot less lending means a lot less money supply, which equals fewer dollars. But let's not forget the massive unintended consequences the Fed creates if they were to take interest rates into negative territory for a long period of time. Of course, this incentivizes the banks to have no reserves whatsoever. Think about it. If you were a bank that was being charged 5% for your reserves, you'd want as little reserves as possible. But if they have no reserves, what does that do to the entire banking system? It makes it far more unstable. So while the banking system in the domestic economy is becoming far more unstable, producing fewer dollars, and velocity is decreasing, outside of the United States, there's 13 trillion plus dollars in debt from corporations and governments. And there aren't enough dollars to pay the debt because velocity has been decreasing at such a fast pace. And you've got the attitude within the United States moving forward that there's going to be a lot less trade. Why do I say that? Because the narrative that you hear constantly right now, no more China, bring jobs back to the United States, and we don't want to rely on imports anymore. If there's a lot fewer imports, that means there's a lot fewer dollars being exported. So if you have fewer dollars being created, fewer dollars getting into the global economy, it makes the 13 plus trillion harder and harder to pay. So what ends up happening is XYZ CEO and ABC CEO that has all this dollar denominated debt, but they don't have any dollars. They have their local currency. They go into the FX market and bid up those dollars. Let's say there's $100 in the market or available. They'll pay 110, call them pesos. They'll say, no, I'll pay 120. The next guy says, I'll pay 130 of my currency units for those dollars. You see what happens to the dollar relative to all these other currencies as it goes up and up and up. Now, a lot of people would argue, yeah, George, but they've come out with these swap lines where the Fed is extending lines of credit in dollars to other central banks, so that will take care of the issue. But if we listen to Jeff Snyder, we know that that isn't necessarily true. Let's go to a recent clip from his show, Making Sense Eurodollar University.
The question is, does unlimited dollar funding to other central banks solve this issue? And the issue he's referencing is offshore dollars, dollar swaps, the Federal Reserve. Jeff.
No, it doesn't. And the reason is because, again, we have to break it down and understand exactly what the Federal Reserve is doing. What the Fed is doing, as the question pointed out, or the questioner pointed out, all the Fed is doing is offering dollar swaps to other central banks around the world. And initially, it was only a group of five, I believe, central banks, the major central banks around the world. No China, no emerging markets, none of those people were involved until later. It wasn't until March 18th and 19th that the Fed finally changed its rules. So what the Fed is actually doing in the figurative sense is not performing its role of dollar central bank. It's actually saying, look, dollar problems outside of the United States aren't really our problem, but we recognize that there is an offshore dollar system. Therefore, we got to do something. So we're going to do as little as we possibly can. And that little we possibly can is to let other central banks sort out their own dollar mess. So what the Fed actually does is it's giving these dollar swap lines to these other central banks so that these other central banks around the world can then try to handle a dollar shortage in their own local jurisdictions. And of course, central banks are not set up to redistribute dollar resources in an efficient, dynamic manner. They're very bureaucratic and they're rigid.
So if the central banks really don't have an efficient transfer mechanism to get the dollars into the system, down through the banks into the corporations, you go through this bidding process where the dollar just keeps going up and up and up. The central banks and the Fed really don't have a way to combat it. And if the system stays the same as it is today, that is key, and we introduce negative interest rates, you can see how the dollar could go into a hyper bubble. And I'm talking about the DXY going from 100 to 120 to 140. Who knows where it could end? So to answer the specific question, will negative interest rates create a dollar hyper bubble? It all depends on the Fed and the government's ability to bend and or break enough rules to create additional M2 money supply without the commercial banks. If they can't create the money supply without the banks, we very well could see a dollar hyper bubble. In fact, I would say it's most probable. But if they're able to figure out a way to create additional money supply and then they take it to an extreme, which we know they most likely will because the government has to inflate away their debt, we could see the complete opposite, where instead of a dollar hyper bubble, the dollar completely collapses. For more content on the future of the dollar that will help you build wealth and thrive in a world of out of control central banks and big governments, check out this playlist right here, and I will see you on the next video.